Hey there, everyone. Happy Friday, June 6th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, founder of Market Misbehavior, and I'm so glad you are here joining me here on our live stream. Friday is an all mailbag episode, which is what we like to do. We'll do a quick market update. We'll answer some of the great questions we've received this week. We didn't have time to answer during the normal broadcast. Usually a lot of fun and kind of a go anywhere episode, which is always kind of interesting. Plenty to talk about market-wise. The S&P closing around 6,000 today. Big spike higher out of the open, kind of choppy session. I feel like the headlines and the flurry of social media market-moving moments continues here. So we'll do our best to cut through the noise, focus on the trend. I know, as always, what you guys are probably very interested in, which is an update on the rooster situation here in Redmond, Washington. They're back, and I don't seem to be able to get rid of them. As far as we can tell, we live near right along a major trail going from up in the mountains down to Seattle that's built over a water pipeline. And apparently what we learned from some of our more rooster-friendly neighbors is people, unfortunately, dump roosters they don't want out on the trail. First time they've come in our property, though, and now I can't get rid of them. The dog seems to get along. They're kind of having a little friendly banter every time she goes out. So I guess they're ours now. If anyone lives in the areas and wants roosters, send me a DM and I'll see what I can do, as long as you can catch them. We also found a bobcat in our driveway yesterday. So it's a whole bunch of things happening here. With that in mind, let's focus on the market, shall we? Looking at the S&P, the NASDAQ today, decent update. The big movement was out of the open with positive upswing based on the latest jobs number. And from there, kind of a choppy session, but the S&P up 1% to 6,000. The Dow up 1% as well. The NASDAQ composite up 1.2%. Mid caps, small caps, all up as well. And let's see, the VIX slightly lower. Actually, not so slightly, almost 2 points lower. So the VIX finishing the day just below 16.8. So we're continuing to have a low volatility environment. Generally, when you have volatility this low, and at least below 20, basically suggests an uptrend phase, right? Until proven otherwise. And we've covered, hopefully this week, you've caught on the show, what are the things we would look for that would tell us otherwise, right? Because I always say market's going up until otherwise, until proven otherwise, or the market's going down until proven otherwise. So, what is it that sort of provides that proof that something's different? Things like breadth deterioration, price action, breaking a line in the sand, volatility increasing. Those are the kind of things. Leadership rotation into defensive sectors. We're seeing breadth not great this week, but other than that, none of those other warning signs, those red flags are really flashing just yet. So it continues to be sort of an uptrend, innocent until proven guilty. And we'll see as we go into next week. Rates going higher today, right, with the jobs data, more encouraging than what we received earlier this week. That's making rates go higher. So basically, investors selling off in bonds, rates going up implies economic optimism, right? Sort of expecting further growth down the road. So rates can continue to go higher based on those expectations. General cycle here, right, is at some point, if you do continue to get economic growth and things are good, at some point rates get up so high that things start to get pretty expensive and it's harder to borrow, and that's what often slows things down. And that's kind of the normal business cycle that we experience. For now, rates going to the upside. 10-year yield above 4.5%, long bond yield close to 5%, and that's sort of the trend that we're at. So stocks up, bonds down, dollar up about 0.5%, a little bit higher here. The commodity space kind of mixed here. Gold down, silver up. The GLD down 1.3%. From yesterday's close. It was pretty much a down day here. So gold kind of whimpering into the weekend is how I would describe it. Silver price is a little better. So a bit of a divergence here that's happened a couple days this week where gold and silver have disagreed. Copper prices down, oil prices up. So sort of a mixed bag here. But I think the move higher in crude oil is an important one, right? So crude oil, natural gas prices all up. The energy sector ended up being the top performing sector today. Cryptocurrencies, yesterday was pretty rough, right? And as we were doing the show, we were talking about Bitcoin getting down toward 100,000. From there, we've actually bounced higher to push back above 104,000, which is where we're right about now. So Bitcoin, Ethereum, most of the other top 10 coins on the stock charts platform in the green today. Looking at the 11 S&P sectors here, energy number one up 1.9%, strong finish to the week. Consumer discretionary, communication services, two of the three FANG sectors up 1.3%. The worst performing sectors were still up. So all 11 sectors finishing the week on a positive note. Materials, REITs, and consumer staples all up less than 1/3%, but did manage to make a positive session here. The breadth was good today, and I think that's one of the differences we saw today. Again, it shows you what a lack of really negative tweets and some positive economic data is amazing what that can do to a session after the week that we've had. But 83% of the S&P members were up, 70% of the New York Stock Exchange listings were up, 86% of mid caps and small caps. So overall, a nice way to finish the week here. Overall, Broadcom down 5% today, so sort of a downside outlier. While most things seem to have a pretty good day and the breadth was good, Broadcom, which has been a pretty constructive name here recently, actually moving lower. Netflix down 0.7%. Tesla up. Alphabet up. Those were both up over 3% today, and those are your top performers within this group of Magnificent Seven and friends. So finishing off the brief market update here, and as a reminder for my Market Misbehavior Premium members, the weekend is super important. That's when we release our weekly flight plan. That's our main report where we take a step back when the markets are closed. We look back at the week that just happened, what was new, what was different, what was meaningful. We look forward at the week to come. What levels, pattern signals are we looking for? That's what I see as my main offering out to investors is that weekly flight plan. So you have to be a premium member to access it. You can find more info at marketmisbehavior.com/premium. Use the code YouTube when you check out there for 30% off your first 12 months on any plan. But as a brief sort of preview of what we'll be talking about with our premium members in a lot more detail. So the primary trend in the S&P, I think, persists here. This close at 6,000 marks a new high close off of the April low. So as much as I can tell you why the market should not go up, well, I can tell you the narrative that would make the market not go up higher. Price is what's most important. The trend remains strong. Things that I'm looking at, though, in terms of potential danger signs, a potential momentum divergence here. We have the S&P at 6,000, but the RSI lower than it was at that May peak, the last time we were getting up toward these levels. But when you look at main levels of risk, the bullish percent index on the S&P is back above 70%. Offense still outperforming defense since mid-April. 73% of the S&P members above their 50-day moving average. So short-term breadth has turned negative here from mid-May, but enough things have been positive, and certainly those Magnificent Seven names have been strong enough to keep the market generally on the positive side. So our market trend model looks like it will remain bullish on all time frames. S&P making a new upswing. That's all pretty constructive. What we'll do on that report, by the way, this weekend is dig into some of the key particular charts we'll be looking at to gauge when this uptrend phase is no longer in place. But for now, it is until further notice. And I do see some of the questions coming in. We're going to focus on some of the questions we received earlier this week. 3P Investor, by the way, I see your note, and I did see your comment come through on YouTube. I really appreciate you. You summarized the podcast interview with Jessica Inskip very, very well. I have no control over how comments, whether they're surfaced on YouTube or not. I wish I did. That's one of the downsides of being on a platform like YouTube. The great news is it allows us to exchange information and allows me to see some of your comments, which I appreciate. So I did see that comment come through, and I appreciate you doing it. And let's get to some of the questions here. Question one. All right. Whoops, I deleted it. There we go. I was wondering if you have any suggestions for indicators comparing current volume versus average or typical volume at the same time of the day. This came up during our live stream earlier this week. I love that question. And the short answer is, yeah, there are different, certainly. And as you probably know from watching the show, I use the stock charts platform primarily. There are a lot of charting platforms out there. I challenge you. There are still charting platforms I've not used, but very few. I mean, I've spent a lot of years as an institutional investor using Bloomberg, FactSet, Reuters, Icon, Panarray, all sorts of different things. And then I've also, done a lot of retail platforms as well. Market Surge when it was called MarketSmith, TradingView, stock charts, a bunch of other things. So I'm showing you what I use primarily, but just remember that every charting platform has its own strengths and weaknesses. I will tell you why I use the ones that I do and what I find most helpful. But your question was, can you look at current volume versus the typical volume? There's a chart on Bloomberg that I used to use all the time, and I forget what the function was, but it would allow you to show the intraday volume and show the average volume at different points in the day. And I found that super helpful. Stock charts in their ACP, which is the advanced charting platform, does have some tools for this. You need to have, I think they call it the relative volume pack, which I believe is a free plugin for members, if I remember right. So check me on that. I hope that's true. There are two that I will show you. This one is called relative volume, and this gives you daily bars. And I'm not showing the actual volume, which would just be the volume, like the number of shares traded. But this actually is the indicator at the bottom. And a level of 1 means it is right at its average volume for the last 50 days. And you can change that and say 20 days or 100 days or whatever you want. You can change the average that it's using, et cetera, et cetera. But basically what I'm saying is show me where we're at now versus the last 50 days, right? So a level of 1 would mean we are at the average for the last 50 days. If we're at 2, that means we're at double the normal volume for the last 50 days. And it's great to just be able to quickly eyeball, which were the days when we had significantly stronger than average volume. And also helps you focus on like this period, which was the gap down and sell off. This is the chart of Apple that I'm looking at. And you can see the daily volume was just way more, 2-3 times normal. And then we can see this period here where the volume has been a lot lower than normal during this period. And a lot of people just use a regular daily volume reading and then just put a moving average on the volume. You can kind of get to the same place, but this makes it a little more statistically meaningful because you can immediately zone in on, multiples of the normal volume reading. Now, you were asking about a different thing, and I'll see if I can do this without completely butchering my chart. But if I do this, I added a different called relative volume time of day. I'm going to make it a 5-day chart. So then this is basically saying for the last 50 days, what's the average volume? And let me make it a 1-day chart so it's not as confusing. All right, so we're looking at 1 day. This is separating the day into 5-minute segments. Basically, this is showing me the relative volume for that time of the day. And so we can see here is the actual volume in blue. The white level is giving me the average volume for that time of the day, right? So what you have to remember is in any sort of US equity, you're going to have a ton of volume in the first like 15 to 30 minutes. You're going to have a ton of volume in the last 30 minutes to an hour. And then it's usually pretty light in the middle. And that's that sort of U shape that you see on this chart. And again, this will help you identify if a move at a certain point of the day is normal or not, because if you're above that average, that tells you something's more significant. But remember that generally speaking, there's sort of a big spike in the first half hour, a big spike in the last half hour, and then the rest of the trading day is pretty light, relatively speaking, on volume. Now, these could be on liquid names. It's still a lot of shares being traded. It just looks like a small number because it's dwarfed by the volume you have at the beginning and the end. So those are some of the tools I would use to look at relative volume on stock charts. On the ACP part of the platform, there's an indicator pack that's called the relative volume pack. As far as I remember, that's free for stock charts members to install. I would encourage you to experiment with that. And there's other indicators in there, and the help pages on stock charts ACP will give you a lot of detail about what those indicators are and what they do. And I saw your comments, by the way, on there. A number of you, yes, I did see. I actually texted my family a picture of the bobcat because I went out to take the trash and I was like, or I'll wait a little bit because there's a bobcat right there looking at me. But I got a great picture of it, and then I sent to my family and said the bobcat may be having chicken for dinner, which is a very dark humor, but it was a weak moment. I couldn't stop myself. All right, question number 2. How can we tell if it is retail or institutions driving market moves? I often get questions like this, and I appreciate that so much. A great time to ask this. My interview with Jessica Inskip this week, we particularly talked about this. She actually made a comment about retail versus institutional investors. I posed this question to her. I'd encourage you to listen to that episode to get her version of what you can do to sort of assess those particular things. What can you do though? I would say, to be honest with you, with anything you're looking at and trying to determine, institutional volume versus retail volume, you're making assumptions, right? I mean, individual prints aren't tagged with, was this a retail investor or an institutional investor? I remember, from my time working at big money managers, you had the benefit of having a trading desk that could pick up the phone and call the traders at major, banks in New York and say, what's going on with this stock? And they will tell you, we think that it's hedge funds doing blah, blah, blah. Like, they would be able to understand individual traders and what they were probably doing, or they would know big volume moves and what it might mean, or they would be able to say, no, it's just retail. And that's because they're studying the tape and looking at individual trades, and they really understood the flow of orders and how they're being processed. And they could also look at dark pool volume and other things, and where we were actually putting our orders and all those sorts of things. Now, most of us don't have the benefit of calling the trading desk and saying, hey, what's going on with Electronic Arts today? So we're left to make inferences based on the information. So, a couple things that I would say that I would think about. Generally, when you see a big move in the market or a big move on the stock, and there's not a lot of volume attributed to that, right? So if you have a big move on lighter volume, a lot of people would assume that that's more retail investors. I think generally that's a safe assumption, right? Just because generally institutions are still managing a lot of capital, arguably all coming from retail investors, but it's not individuals making the trades. It's big institutions moving big volume, right? So you have to remember that at a large firm, it may take you hours or days or even weeks to make a trade, to complete a trade, because of the amount of volume that you're trying to move. And you don't want to move so much at one point that it shocks the market, and all of a sudden you get you get bad fills, and you get disruption in the in the normal liquidity of the market. And so heavier volume implies heavier activity by bigger investors generally. So the shorthand we tend to look is, when there's a big move in a stock, you immediately glance down to the volume and say, is there a lot of volume attributed to this move or not? And when you see a big move on lighter volume, it implies that's more retail investors, probably not as many institutions behind it. You probably want to be fading that move. If there's a big move on heavier volume, that assumes that there's a lot of institutions involved, and probably that's a more valid move on the chart. Having said that, as you probably know from watching my show, I don't use it. It's funny that both of these first two questions are volume oriented. I don't use volume a ton. As a matter of fact, you could tell I don't have it on my chart. I have to add it on later. So one of the things that I tend to do is, instead of looking at the straight volume reading, I look at indicators that are derived from volume. And there are three that I have used that I know of that I think are all very, very good. And depending on, you should consider all these. On balance volume is a very simplistic way that Joe Granville created to look at trends in volume over time. Mark Chaikin, I think, innovated on that work and created what's called the accumulation distribution line, and then the Chaikin money flow, which is the one that I used. They're similar, but have some nuances in terms of how they're calculated. The Chaikin money flow, I think, is fantastic. That's the one that I tend to use. And basically, if it's above zero, it's a period of accumulation. If it's below zero, it's a period of distribution. So looking at moves in the stock and recognizing when we change from accumulation to distribution tells me we're in a period where institutions are probably unloading shares. And when we go from distribution to accumulation and cross back above the zero line, that tells me we're now seeing enough signs of accumulation that we're heading higher. I would encourage you to dig deeper into those. For my premium members, we're recording a series of courses, going through each of these indicators and talking in a little more detail. But those are some of the things that I would use to try to make an inference. And I would caution you, anytime someone says, I can tell you exactly whether this is retail or institution, it's actually not possible to know exactly. You're making some assumptions somewhere along the way, either a little assumption or a big assumption. Doesn't mean it's not still a meaningful use of your time. Next question. Have you ever considered using the Keller market model as a guide to the percentage of equity investment allocation? Would the addition of a trend line break, horizontal or angle, add any benefit? I love that question. I get questions on this market model often, and I appreciate that. You can see that model in two places, by the way. The one is, watching my show, because I'll randomly put it on here. But the other is on stock charts. There's this widget called the Keller market model, which is basically taking a series of weekly charts that we have stored on stock charts and just looking at the different time frames and making it a little dashboard like that. And I found this super helpful. I also on Optima have run it on a bunch of other things, and I actually share those now with my premium members to show them kind of what the model's saying about a bunch of ETFs and so forth. So you're actually asking about the model itself, and I will tell you right off, sure, either of these things are possible. I have a rainy day list of, this is actually version 2.0. Version 1.0 was not as good. I kind of adapted it to this version a couple years ago, and there's a version 3.0 floating around in my head that at some point I will devote some time to fleshing out a little bit more, but would want to do some testing and a lot of work on it. You're saying, could you look at trend line breaks? For sure. I mean, you definitely could. Could you put a smoothing mechanism like a moving average on this, a signal line, which is what like the PPO indicator does? You definitely could. Could you, to your point of like, how does this think about with allocation? For sure, right? And so one of the things that I like to do, if you think about what this widget is basically showing you, not the stocks one, but more like the macro version. This is basically saying here's stocks, bonds, commodities, and the dollar. And again, what I do on my own time is run this on a bunch of other ETFs, for gold, for Bitcoin, etc. And just think about which asset classes are showing positive trends, which asset classes are not showing positive trends. Given this, I would say, does this mean I should be owning more dollars or more stocks than bonds, right? Yeah, I hope so, right? I mean, I hope by analyzing these charts, you would come to some conclusion of I should be more allocated to stocks or bonds, given the fact that the stock model is all bullish and the bond model is all bearish. How you actually do that and how you change your allocations and how you use this to think about the percentages and how they tilt. That's something I usually leave to people on their own to sort of make their own assumptions, because there's a lot of other things you want to consider. Definitely something on the back of my head, some sort of systematic way of using this model and reallocating around different ETFs. 100%. That's on the Dave wish list for sure. All right. Happy Friday. Is CRDO forming a pennant? All right. I like the straightforward question. We go from a little more broad to a little more specific. Is CRDO forming a pennant pattern? So let's zoom in a little bit, right? So we're zoomed out so much I can't really see. So let's go to like a 6-month thing. Yeah, I don't mind that. I would say so. What does that mean? If those of you that are not super fluent in the language of price patterns and things like that, a pennant pattern is where you have a big move like this, and then you have this kind of, short-term pattern, a consolidation of lower highs and higher lows. What makes this a pennant is that it's a much shorter time frame than sort of the trend that you're looking at. It looks like just a little blip on this longer-term trend. If it was a much bigger triangle, I would call it a symmetrical triangle or a coil pattern, which kind of has its own methodology. But a pennant pattern implies a short-term consolidation within a longer-term trend. 100%. What makes this a confirmed pennant pattern is we break above the upper, and I've crudely drawn this, but you break above the upper boundary, and that would imply that whatever was happening leading into that pattern, you're probably going to get a similar move coming out of the pattern. It usually happens about halfway up what's called the flagpole, which is the larger trend. So yeah, I would say that's I would probably label that a pennant pattern. It's a confirmed pennant pattern only if and when you break above the upper trend line. So I would probably spend a little more time drawing these trend lines more accurately than I just did for time's sake, and look for a breakout above the upside as a validation of a further upside potential, for sure. The best book to read for pennants and other patterns like that, the Edwards and McGee classic book, Technical Analysis of Stock Trends. And one of my former analysts at Fidelity was Susan Berger, who is now retired and runs her own, has written a really good book about her life experience. She actually, her first job in the industry was working for John McGee of Edwards and McGee. He was based in Springfield, Massachusetts, I think one of those Western Mass cities. And true story, one of her jobs was to change the ticker tape because he had a custom made desk and a ticker tape machine, and the tape would be fed through the glass top, like right underneath the glass. So while he was sitting at his desk, he could watch the market going by on the ticker tape. Isn't that a great story? I love that one. All right. True story, by the way. All right. 2 more questions, then we'll call it a week. Can you briefly explain or go over chart 832 Coppock curve and monthly PPO? Yes, that is a chart you are finding on the Market Misbehavior live chart list. You can find that list of charts accessible anytime to you at marketmisbehavior.com/charts. It'll get you to this an updated version of these charts. I keep them updated pretty regularly. You're talking about this one down here. Yeah, 832. Yeah, so there are a couple things here, and this is a chart that's kind of it's kind of a work in progress. I tend to think of charts as an ongoing conversation you have with the markets, and I think that's a great way to think about charting and technical analysis is saving your observations through lines, through comments, through whatever it is, colors, shapes, whatever's going to help you remember and recognize what you were thinking. This is using kind of 2 different approaches to think about uptrends and downtrends. The uptrends and the green vertical lines that you see here are based on the Coppock curve, which is at the bottom. This is an indicator that was designed by Sedge Coppock, who was an analyst back, a number of years ago. And he basically did a bunch of analysis on major market bottoms and how you could confirm that the low was in. And the anecdotal story is he talked to a pastor, like an Episcopal priest or something like that. I'm butchering the story now, but I'm paraphrasing it, and asked how long it took for family members to mourn the loss of a loved one, and the answer was 11 to 14 months. And so those were the 2 moving averages he used, and that is the anecdotal, probably not totally true, but it's a great story of how this indicator originated. But it's literally when the market's in a downtrend, investors are in a period of mourning, I guess. And when the monthly Coppock curve, which is the difference between the 11 and 14 month moving averages, when that starts to slope higher, that's your sign that that the bottom is in, that the mourning period is over. I was introduced to the Coppock curve right around here when one of my analysts at Fidelity said, "Hey, we need to be long because the Coppock curve went positive." And I'm like, "What?" Like, this is this is like May 2009. I'm like, "Dude, I don't know, but show me what this is." And we went through it together, and I was like, "Okay, I get it." Like, we went through major lows and saw how well that had worked previously. So the shape of that, the Coppock curve, when it is going downwards, and then when it finally slopes higher, when it's higher than it was the previous month, that's a bullish Coppock curve. Now, Coppock did not use it to identify tops. It was just an indicator to identify bottoms. So on this chart, I put a green vertical line when the Coppock curve turns positive. Most recently, it was January 2023 when it turned positive. Pretty decent signal. Now, for kind of the bearish signal, which is a vertical red line, I'm just looking at the monthly PPO. I was just experimenting with different things and looking for a crossover, a classic sell signal from that indicator as maybe a way of identifying major tops. Not bad and sort of interesting. And this is one of those indicators. I don't know if I would manage a portfolio based purely on this, but I'm a big fan of things that are long-term indicators that don't signal often, but when they do, it's usually not a great idea to fight it, because it tells you that the trend is kind of you're kind of fighting the tape at that point. Now, I don't have a red vertical line, but it actually did signal, I believe, at the end of May with the indicator going. The monthly PPO actually registered a sell signal. I'll have to look at that to be sure, but that certainly looks at what we would be at here. So most recently, a sell signal there. So that's what the chart is. It's looking at the Coppock curve for sort of a buy signal and the monthly PPO as a sell signal. There are other indicators you can use on both sides of that. Like, instead of the monthly PPO, like the Hindenburg Omen is a common technique that I like to highlight. That's really only designed to signal at tops. But that's what that chart is. If you have questions, certainly drop them in the comment section if I can go through that further. Final question. I had a great shopping experience at Nike Factory Outlet this weekend. This was last weekend, I believe. It had me ready to buy, especially with it back above the 20-day moving average. How's the chart looking? What I love about your question, by the way, and the reason why I want to highlight that, is a very Peter Lynch approach, right? He famously would take his daughter to the mall, to the shopping mall, and see what products and stores she liked, what products and stores she didn't like anymore. He would use that anecdotal evidence to start to think about what companies were interesting. And at my time at Fidelity, we actually every time we would have summer interns, one of the favorite meetings would be getting all the interns together and just grilling them on what apps are you using, what social media platforms you're using, what products do you like, what shoes do you like, and just sort of always focus on younger, newer investors and what products and things that they were interested in. Not that we would blindly buy anything based on that, but it just helped us get some anecdotal evidence and some ideas of what to look at a little further. So sort of the Peter Lynch buy what you know a strategy, which is I love that approach, and using that as a starting point. So foot traffic at a Nike factory outlook aside, what's the chart looking like? So this is one of those stocks having a nice bounce off of a very low level. I think the question of whether or not this fits into your portfolio is really more of a question about how you like to manage things, right? So if you're more of a value investor, someone who's more interested in contrarian plays and buying things that are beaten down, I could see why a chart like Nike would look very compelling, because we made a new 52-week low in April. We're very oversold. We can see previous times where we're oversold, and we often get a pretty decent bounce off of those levels. So pretty interesting time. If you look at like the PPO indicator, I'm sure it's given a buy signal by now. I can look that up. Here's the weekly PPO, just giving a buy signal. Looks like this week maybe, which is pretty rare, but pretty powerful. But for me, I'm much happier owning things once they're back above the 200-day moving average. That's how I would tend to do it. So the problem with charts like Nike, they've been in such a downtrend for so long, they're still below a downward sloping 200-day moving average. And I would always rather own something above an upward sloping 200-day than below a downward sloping 200-day. As a matter of fact, the last 1, 2, 3, 4 times we've hit the 200-day moving average, that's been it, right? And we've kind of come back down. So a trade and betting on a swing from that April low back up to the 200-day, I think that would make a ton of sense based on my interpretation of the chart. Have I seen enough on the chart to say this is a great stock to build a portfolio around? I would not personally say that until we start making progress and actually show we can't get just to the 200-day moving average, but through the 200-day moving average. Great questions, by the way, some fun ones today, and a bunch of different things to hit on, which I appreciate. Thanks so much for watching the live stream. I saw the comments about interviewing Ralph at Campora. I'll see what I can do. I do know Ralph well. He was one of my mentors early on and really through my career. I'll check in with Ralph, see if I can convince him to come on the podcast. Some other great podcast guests lined up here in the next month or so, and I'll update you as soon as I can get all the details worked out. So we'll see. But in the meantime, have a fantastic weekend. Hope you enjoy it. Stay safe, have fun, and have a great weekend. We'll see you on Monday. Remember, it's always a good time to own good charts. Take care, folks.